Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Eric Bahn of Hustle Fund. Eric, thank you for joining us.
Thank you, Hall. Really great to be here.
So can you tell us a little about your background as what you did before you got into early stage investing?
Yeah, certainly. So I spent about 15 years as an operator. Came out to Silicon Valley, grew up in Michigan, actually. So came out here at 2000 at the end of the first .com boom and just got sucked into the community here, got sucked into a career of technology. Most of my career has been working as a founder. So I spent about 9 years running an education company, sold that to a larger media business out in London, and then had a slew of interesting projects, started a media company called The Hustle, which is still going strong. And my last real job, I was leading ads algorithms at Facebook and Instagram as a product manager. So had a small stint as an EIR at another fund and then launched Hustle Fund just a year ago.
So what led you into the startup investing sector?
Yeah, so when I had completed the acquisition of my first company back in 2012, I was fortunate to have a little bit of liquidity, but was also in a learning mode. And I found that by writing some checks to promising teams with founders that I've always wanted to work with, it was a great way for me to just learn about what they were doing and get a better sense of some of the markets that I was following. And it turns out that investing is something that's highly addictive for a lot of folks. So what began as an angel investment track ended up becoming a professional investment career.
So for those who want to invest in startups, what's your advice for those people based on your experience?
So I get this question a lot, and particularly with folks who are a bit earlier in their careers. And one of the challenges is that sometimes there's a real lack of liquidity in order to get into building a real portfolio as an angel investor. But I have a couple ideas here. The first is, at the very simplest level, if you have some level of liquidity, a couple $1,000, it is possible to get started on angel investing by participating in deals that you see on AngelList. So AngelList has a really great platform. You can generally put in a little bit of dollars here and there, but you might actually still be throttled if you're not an accredited investor. So your audience may be already aware of this term, but to be an accredited investor, you generally have to fulfill one of two criteria. One is to have a net worth, a liquid net worth more than $1 million, or to have some sort of a salary that I think exceeds like $200,000 roughly per year. So if that precludes you, then the other idea that I have for building your portfolio is to just begin advising companies. So if you approach startup founders, say, hey, I want to provide some free work and here's the unique skill set and value that I can bring. A lot of times, especially if you're going early, founding teams will be open to providing maybe some small portion of equity for your time for the next year. And that is a virtual way of building a portfolio. I think that could be highly effective in starting your story as an angel investor.
That sounds great. Start small and work your way up is a great way of getting into it. So tell us about the Hustle Fund. Why did you start the Hustle Fund?
Yeah, so I can explain what our thesis is. When I was an EIR, I was working at this fund called 500 Startups with my long-term co-founder and collaborator, Elizabeth Yin. At the time, Elizabeth was actually running the accelerator program. And for those of you who aren't familiar with 500 Startups, it's a notable accelerator and also a seed stage investor. We found that there's a very fundable profile of founder right now in Silicon Valley. And the way that we sort of like to describe this is by talking about a genetics term, which is phenotypes versus genotypes. So if you remember your high school biology, phenotypes refers to how a person looks, so the appearance of an organism. So for example, if you saw me right now, I have black hair, I got brown eyes. Those are phenotypes. Genotypes are the genetic traits that are coded within that aren't necessarily discernible with your eyes. And it's our contention that in the earlier stages of investments for seed investors, naturally you kind of want to focus more on how good is this team? Do they have what it takes to build a fabulous company with a fabulous outcome? And it makes sense to focus primarily on team at the earlier stages because you're lacking things like true business metrics like revenue. You might even have not a really well-formed product to review. But we believe that most seed investors are indexing too much on things like phenotypes. So quite bluntly, if you're a white or Asian man with a computer science degree from Stanford or MIT, worked at a Google or Facebook or Amazon or whatever, you're going to have an easier time raising money than founders who don't share those phenotypes. And I'm using the term phenotypes a little bit loosely here. It also is inclusive of things like pedigree. But what we discovered at 500 Startups is like when we saw this massive portfolio of companies, at the time it was the largest seed investment portfolio in the world of 2,000 companies. We couldn't find a good correlation between people with quote unquote favorable phenotypes, and I say that with very heavy air quotes, and outcomes within the fund, teams that are actually doing well. But in the course of this research of studying these early stage teams, we found and stumbled across a better early indicator for success, which we describe as the hustle genotype. And the hustle genotype for us is defined really easily. Or very simply, it's teams that know how to execute and execute fast. And it turns out that hustle is quite measurable. You can normally see it in things like code commits, number of experiments run in a given week, customer development calls, sales outreach, your sales funnel, and so forth. And we believe at Hustle Fund that the best teams are those that exhibit hustle and basically can grind out the best results over time. So the problem with genotypes and discerning the hustle genotype is you can't necessarily see it with your eyes. So the way that we've been able to find founders who possess the hustle genotype is by inventing a new model for how we invest. So it starts off with a small check. We're writing 100 checks of $25,000 a piece to begin engaging with teams initially. We'll then work with each of these teams on a growth project for 4 to 6 weeks. At that period of time, we can build a joint dashboard to track our work. The teams will be able to assess their hustle and watch their team dynamics as they work. Reciprocally, though, the teams are assessing us to make sure that as investors, we're providing real value and hustle as well. And what we're finding is that in about 20% of the cases, after we do that growth project, that we determine that there's a great fit on both sides. And we'll ask to participate in the next financing round with a larger check where we can concentrate investment into that team. So 100 small investments, work with each team on a growth project to assess hustle on both sides, leading to 20 core positions within our fund. And we found that this model has been working really well for us. Since September, we've done 39 deals and about 6 follow-ons.
That sounds great. Most funds break themselves down into sector and stage. We're in tech, we're doing seed, we're in healthcare, we're doing Series A. And here you're actually breaking it down based on execution, what people actually get done and get going forward on it. And it sounds like it's working pretty well with it. How did you come up with that thesis?
Yeah, and just to clarify, we are what we describe as pre-seed fund. So we like to come in alongside of family and friends and angels as typically the first institution into a team. And this is a unique model. We haven't seen this executed in this form within the seed sector as well. We are, from an industry perspective, sector agnostic. We'll invest in anything that we describe as software enabled. In terms of how we came across this idea, again, it just came from working and observing and studying lots and lots and lots of founders, both through our angel portfolio, but again, through 500 startups. So when we are running the 500 Startups Accelerator, me and Elizabeth, we actually have reviewed over 20,000 deals. The way that math works is in any given accelerator batch, there's typically 50 spots that are open every quarter. And somewhere between 2,500 and 5,000 applications would come in for those 50 spots. And from reviewing so many deals and seeing sort of the correlations between teams that know how to operate in high velocity versus those that don't, this helped us to refine our fund model and our investing model.
So what kind of startups are actually fitting that thesis, or do you have specific examples of ones that perhaps got the follow-on funding, and what were they doing as far as their project goes?
Yeah, we have a variety of companies that are in our portfolio right now, but let me describe one company in particular that I love. It's called Fleet Panda. So at a high level, what they are doing is providing fleet maintenance and fueling services for last mile small fleets. So if you think about Amazon, today it is actually driving e-commerce. It is creating a huge amount of volume of packages year after year as consumers become more and more conditioned into buying everything on Amazon. Turns out that FedEx and UPS and DHL and the likes aren't capable of handling the entire volume themselves. So one of the fastest growing segments of small businesses in the United States, and this might actually be in many markets across the world, are these last mile fleets. So they could be like Hall and Eric Company. We buy or lease 20 trucks, and then we have a contract with Amazon or another e-commerce or on-demand service, and we're providing some of these drop-off shipments to clients or businesses or homes around our region. And What I like about this service is while there's a lot of on-demand fueling and maintenance services on the consumer side, there's very few on the fleet side, focusing on these B2B businesses. So when we invested in Fleet Panda, it was just one person. It was the founder, Pavan, who was a solo founder with no team members. But he had sort of white knuckled his way into some reasonable amount of revenue. So we thought, like, this is worth taking a risk on. Let's make a small check investment to see where this goes. Pavan blew us away when it came to his growth potential, his growth execution that he proved through his data. And today it's probably one of the fastest growing companies within our portfolio. I can't reveal what their monthly revenue looks like, but it is astoundingly high in the past year that we began to work with him. He's grown an exceptional team, and he's on his way of executing a great Series A sometime in the next 6 months. But what I liked about our model is if we had a concentrated portfolio approach where we were just writing $300,000 checks off the bat, then there's kind of a high bar and high level of risk in writing a check that size, even at the seed stage, because like we would have to have a lot of conviction to be totally right every time we wrote that check. With a $25,000 check, we can make some risks. Like I wasn't very big on writing a check into an energy related business, but I thought the founder was cool. And it turns out just by having some more exposure to this person, by working side by side with him, that he's turned out to be one of the best performing companies in our portfolio today. So what I love about our fund model is that it builds in what I describe as institutional serendipity. We can be surprised by people by taking risks on companies that we would normally be uncomfortable investing in, and then hopefully be rewarded by taking that risk, by being able to follow on.
So by gathering these hustler startups that come into the deal, what are the challenges, maybe the top one or two that you see all of these guys facing to make their business work? Obviously, they've got a lot of execution going on, and that's great, but where do you see the challenges they're encountering?
Yeah, so I think that to be specific about the teams that we like to fund, we want to back teams that are venture backable. And what that means is that the team is going after an idea that requires smart capital, a lot of smart capital in their journey, and will also yield an outcome that is hopefully 100x from the initial position that we took in the team. So for example, if we're investing at a $3 million valuation, the team is really gung-ho about hopefully killing it past a $300 million exit or IPO at some point. This is the only way that we can justify investing in the team to produce a return for our LPs. And the problem, though, is that if you're a venture-backable company, playing a VC game to get to your next milestone, which is typically a fundraise, your subsequent fundraise, is really hard. There's what we're noticing, at least in the VC ecosystem in Silicon Valley, is that the teams who are successful in raising maybe a post-seed raise or a Series A have to reach some pretty high thresholds. Typically, it's a couple months of 20% month-over-month growth. That's really hard to achieve. Or hitting a revenue of like 300 to 500,000 MRR to reach their Series A. That's ridiculously hard to do. So I say that the top threshold, or I guess throttle point for a lot of the teams that we work with, is meeting the expectations of downstream venture capitalists to get to the next fundraise in terms of their velocity of growth month over month, as well as their revenue targets.
So as an investor, you're taking risks, and there's many risks in these startups. There's team risk, product risk, market risk, etc. What's the one or two risks that really concern you about these deals or keeps you up at night because it's the one risk they have to come over? Aside from raising follow-on funding, what's the risk that you see coming in that you have to mitigate?
So I'll focus on one, which is hiring. So I have noticed actually that there is a correlation between the teams that are doing really, really well in our portfolio and the CEOs that are in place who are successful at closing great people. And this is one of those things where it is extremely hard to discern whether a CEO or founder is really great at getting and convincing the very best people to join their team. There could be really smart people that we're backing who are showing really strong growth results, but are they a scalable leader? And that's something that takes a long time to figure out. So the thing that makes hiring so scary is, well, let me just sort of talk about the context within Silicon Valley, but just note for your listeners that we do like to invest outside of Silicon Valley too, across North America. But within Silicon Valley, when I was working at Facebook as a product manager, my entry-level engineers right out of college were earning close to $300,000 a year. And when you are trying to convince them to join your super early stage startup, you have to convince them on a couple fronts. The first is that it's worthwhile to work harder than your current job at Facebook. you're going to be earning probably a small fraction of your previous salary, but it's worth it because there's upside at the end of it. And then I guess the third thing to note too is just like you're willing to give up all these perks like free food, free laundry, free booze, lots and lots of these kinds of wonderful benefits of working in these larger companies for basically like a windowless office with 6 other people that has some sort of uncertain outcome as well. So it just seems like in the Bay, there's more of these questions that you need to have answered and checked off to convince like some of this top talent to leave their steady jobs. It's a little bit better, I'd say, outside of the Bay Area too, in terms of maybe cost of living, convincing people to jump off. However, there's a different kind of threshold also you have to reach there, which is if we're investing in a team in Indianapolis, maybe this founder is really good at hiring its first dozen employees, but can they actually hire another 100 in that region? Or will they have to move to a bigger market like Chicago or New York or the Bay Area? And these are just questions that are not easy to answer over the course of a single year, but has to be observed over the course of many years where we have to bring our resources to bear to even coach these founders to hire well.
So it is a challenge to find the right people and the best people and then convince them to work with your business. You see a lot of deals out there, a lot of sectors, a lot of different applications for technology. What do you see as the low-hanging fruit or the immediate opportunities you think will turn into good businesses out there? What's your take?
Yeah, so right now the frothiest sector that we are observing and also participating in is crypto. So there are a lot of crypto projects out there. They're doing private sales, in some cases ICOs, raising $20 million at a time. That's kind of nice, I suppose, for the founders. But we're more or less very hesitantly participating in what we describe as token purchases, participating in these ICOs. For investors, I think it's a really difficult way to make money. There's so much volatility. It's frankly a different skill set to be successful here as a token speculator than being a venture capitalist. Like it's closer to being a hedge fund manager, I suppose. But the opportunity that I see for founders is that I think that there is a huge opportunity for what we describe as picks and shovels businesses. So if you think about the California gold rush in 1849, there's 2 winners, possibly. Actually, really one winner in my mind. They're the people who are trying to buy up land to hopefully strike gold. And those are the speculators. And it was a high risk venture. But the people who are really making money were those who were selling the axes, the picks, the shovels, the blue jeans like Levi Strauss did. They're making a killing and being enablers of these services. So all sorts of businesses right now in crypto that you can carve out some pretty solid return as a maybe non-crypto business serving crypto founders. Examples of that could be like maybe a niche service that makes KYC AML much faster. It could be things like custodial services to make sure that you provide really good facilities for storing cold wallets, cold hardware wallets, and so forth. So I think there's a ton of business opportunity here and definitely a lot of capital to pay for these services.
Crypto is certainly the future. Just about everybody I talk to believes that it will be the future one day in some shape or form. It's just not clear what path will take us to get there for sure. So it's very interesting to see the picks and shovels model come up because people will need help along the way to get there to make it work. So that's a good model to follow. In the final minutes of our interview today, what else should we cover that we haven't?
Yeah, so I think one of the things to realize is that for your listeners who are considering venture investments or actually receiving venture investment is that the industry is changing quite a bit. We're noticing that there is an explosion, and maybe this is not just us noticing, this is pretty well documented. There's an explosion of microfund managers like ourselves that are coming to the market. A microfund, in our definition, is any new fund, Fund 1 or Fund 2, that is less than $50 million of assets under management. Our Fund 1, we just wrapped up, is relatively small. We raised $11.5 million. And so there is a variety of investors with a variety of theses out there who are particularly concentrated on the earlier stages to invest in new teams. The attitude towards of this emerging class of VC investors is really great because they tend to be more millennial. They tend to actually have a lot more diversity and inclusion in mind in terms of their approach to the world. And also is starting to discard some of the institutional barriers that Silicon Valley has put up to date. So chummy, I guess, or like doesn't really feel like there's as much asymmetry of power when you're a founder pitching these newer class of VCs. It feels like they really want to be a partner and value-add service provider to you as much as founders feeling like they owe great returns to the VCs themselves. So this is really exciting to be part of this new movement where the old generation is kind of retiring out and this new class of VCs are coming through. And particularly for founders who are based in places outside of Silicon Valley, Salt Lake City, Chicago, the South, like Georgia, I think that there's going to be an explosion of venture capital coming your way too, because Silicon Valley VCs are realizing that great talent and great hustlers aren't just within a small radius within Stanford University. So really excited to capture this trend and see where this goes. But I'm just really excited for the next generation, the next 20 years of innovation.
I agree. It seems like venture capital is going down and out into so many different sectors, stages, and regions of the country that it's becoming much more relevant and prevalent to groups across the country and not just concentrated in one area anymore. So it's a great opportunity to raise funding as well for future startups. So how best for the audience to get back in touch with you?
Yeah, certainly. So if you're a company that is interested in reaching out to us about early stage funding, you can click the Get in Touch button with us at hustlefund.vc. That's Victor Charlie, hustlefund.vc. We do look at every single company that comes through that channel. And in addition, I'm pretty active on Twitter. I'm at Eric Bahn. And I think there's a lot of ways that you can engage with us through a variety of means, like Reddit as well. So we're all over social media. Just start to engage with us in the conversation. And we'd love to learn about what you're working on.
Well, that's great. We'll put those in the show notes as well. And thank you for taking time to share your insights with us today. Hope to have you back for a follow-up and appreciate the work that you're doing for startups.
Many thanks, Hall. And thanks so much for this opportunity. And it was really great work that you're doing also to help this ecosystem with this podcast and your other resources.
Great. Thank you.
Thank you.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.